Hey everyone, welcome back to Finance Friday on Money Girl. This is where I answer your burning money questions. I'm going to be taking a few days off, so I'll replay a show for you. This is one that I get asked about a lot. It has to do with capital gains and what that means for the taxes you pay when you sell your home. In fact, the show you'll hear today was the very first topic that I covered on the Finance Friday edition of the show. So let's revisit episode 826, where I answer a question from Al about what taxes to expect with the sale of a home. And I'll be back next week with a brand new Finance Friday topic. A listener named Al asks, I plan to sell my primary residence for $1.5 million with a profit of $1 million, which will get reduced to $750,000 after claiming the $250,000 capital gains exemption. If I buy a much smaller house for $600,000, am I still taxed on the $750,000 of profit? Thanks for the question, Al. I'm going to answer it today on the show's first Friday Q&A episode. I'm Laura Adams, an author, spokesperson, speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. If you're not already subscribed to the show, what are you waiting for? That is the best way to ensure you never miss an episode. And if you've got a question that you'd like me to cover here on a Friday Q&A episode, please leave it on our voicemail line just by calling 302-364-0308. You can also send me an email using my contact page at lauradadams.com. All right, so let's talk about capital gains and losses and get to Al's question. But first, I want to review what capital gains are and exactly how they relate to home selling. You probably know that you pay ordinary income tax when you earn money from a job or you earn interest on your bank account savings. Well, when you sell certain assets and have a profit, you must pay capital gains tax. And you've got a gain when you sell a capital asset, which could be stocks, mutual funds, exchange-traded funds, or real estate, for more than it cost you. And the capital gains tax rate depends on your income, your tax filing status, and the length of time that you own the asset. And I want to note that if you sell a capital asset for a loss, you have a capital loss, which can offset similar capital gains for a period, and that's going to reduce the amount of tax you owe. However, if you sell a home for less than you paid, you cannot claim a capital loss or deduct it from your taxable income. But you get a massive tax break when you profit from your home sale. So if you're like Al and you're thinking about selling your home, it's really critical to understand how it works and who qualifies for the capital gains exclusion that he mentioned. So let's talk about it. What is the capital gains tax exclusion? Well, it's a tax break for homeowners, and it is called the capital gains tax exclusion. It's a federal benefit, and it allows you to exclude up to $250,000 of your home sale gain from your income as a single person, or double that, $500,000 if you're married and file a joint tax return. So let's say you're married, you're filing taxes jointly, and you bought your home for $300,000. And let's say you've lived there for 20 years and you've done lots of renovations over the decades, and that has brought your adjusted basis, which I'll talk more about, up to $500,000. So by, doing renovations and doing upgrades, you have increased the investment in the home up to $500,000. Now you sell the property and you get $1.2 million realized on the sale. That would give you a capital gain of $700,000. So your $1.2 million realized amount minus your basis of $500,000 leaves you with $700,000 of profit. So you can exclude $500,000 of that profit because you're married, filing jointly, and that would leave you with just a $200,000 gain. So it's the $700,000 of original gain minus the exclusion of $500,000 leaves you with $200,000 capital gain. But if you own this same home as a single taxpayer, you'd only be able to exclude $250,000, leaving you with a $450,000 capital gain. So that's a pretty big tax break, right? Well, to qualify for the exclusion, you must have owned and lived in the home for at least 2 years during the 5 years preceding the sale. And those 2 years don't have to be contiguous. And that rule is a primary reason that I recommend waiting to buy a home until you are confident that you're going to live there for at least 2 years. And this was an issue that I kind of went through with my mom. She moved into a home that she wasn't really sure she wanted to stay in and was thinking about selling it and moving on rather quickly. But, once we looked at what she was going to pay in tax, it really made sense for her to stay there for the full 2 years so that she could get that gains exclusion. Well, it turns out that she decided not to sell the home, but still, this is really something that you want to plan and think about carefully. The timing on selling a home can mean a lot of potential tax savings. So the home must be your primary residence to qualify for the capital gain tax exclusion. And it can be any type of home. It could be single family, a townhouse, condo, mobile home, a tiny home, even a houseboat. And while you can own other properties in addition to your main home, like a vacation home or rentals, those properties do not qualify for this tax benefit. And what's really great about the exclusion is that you can claim it as often as you like, no matter your age or income. So in theory, you could buy a home, live in it, and sell one every 2 years for your entire life to just claim the exclusion over and over and over. Now, the thought of moving that often exhausts me, but claiming it that often is entirely legal. And I want to mention that the IRS wasn't always so generous with this benefit. The gains exclusion used to apply only when you bought a more expensive home within 2 years of selling your old one. Plus, you could only claim the exclusion once in your life, and it could only be for up to $125,000, and you had to be age 55 or older. So, Al, I'm wondering if that old rule is why you asked if the price of your new home matters. It doesn't, and so unfortunately, you will be taxed on your home sale profit less the $250,000 exclusion if you're single. And I'll explain more about how to figure out the exact tax you'll pay in a moment. And if you're married, only one spouse must be listed as the homeowner to qualify for the $500,000 exclusion. However, both of you have to have lived in the home for at least 2 of the 5 years before the sale. Note that if you're a widow or widower who does not remarry before selling your home within 2 years after your spouse's death, you generally qualify to exclude up to $500,000 in gains, as if your spouse were still alive. Now, there are legal exceptions when you will qualify for the full or even a partial gains exclusion, even if you sell your home before living in it for 2 of the 5 previous years. And they include situations like serving in the military or foreign service, being a government official or an employee of the intelligence community, volunteering for the Peace Corps, having your home destroyed or condemned, getting separated or divorced, or experiencing the death of a spouse. You may also get a partial gain exclusion if you sell your home before living in it for 2 years due to a change in your health, a change in your workplace location, or even having various unforeseen events that are described in IRS publication 523 called Selling Your Home. And these are not all of the situations when you're eligible or ineligible for the exclusion, so definitely speak with a certified public accountant if you need guidance. As I mentioned, with some planning, correctly timing your sale and qualifying for the gains exclusion could be one of the biggest tax breaks you ever get. So let's talk about the capital gains tax on real estate. How exactly do you calculate your potential tax on a home sale? Well, as I mentioned, it's the difference between what you paid for the property and how much you sold it for. But calculating your gain on a home gets a little complicated because you may have made renovations or significant repairs. As I mentioned, these are known as capital improvements. A lot of people make those while you live in a property. Plus, you typically have expenses to account account for when selling your home. So let me go through 4 basic steps to determine your capital gain on a home sale. Number 1, calculate your basis. So your basis in a home is your total investment in the property. It includes the purchase price plus expenses related to the purchase, like your closing costs. And your basis also includes capital improvements that increase your home's value. Things like remodeling a kitchen, installing a new roof, or replacing windows. But it does not include things like just basic repairs and maintenance. Now, your home's basis can also be decreased by allowable depreciation and payments received for home insurance claims. So this is why keeping really good records for significant home-related expenses and insurance payments is critical. The second step is to determine your realized amount. This is your home's selling price minus expenses related to the sale. They could be a real estate commission, marketing fees, and certain closing costs. So that is going to give you your realized sale amount. The third step is to subtract your basis from your realized amount. For instance, if your home's basis is $300,000 and your realized amount on the home sale is $450,000, you have a $150,000 capital gain. And the fourth part of this is to determine your capital gains rate. Now, this is going to depend on your income, your tax filing status, and how long you owned the property. For 2024, if you've owned your home for over a year, the long-term capital gains rate applies, and that's going to range from 0 to 20%. And it's more favorable than short-term rates if you own the home for less than a year. So that's why it's typically best to own assets like investments and your home for at least a year. Plus, you may owe capital gains tax at the state level if your state collects it. As mentioned, owning your home for at least 2 years makes you eligible for the capital gains tax exclusion. So that's a really good target to shoot for. When you're thinking about buying a home, you want to be there at least 2 years. And the tax rates are subject to change. You can check taxfoundation.org for current capital gains tax rates. And you can also refer to IRS Publication 523, which I mentioned. It's called Selling Your Home. It's got a worksheet that you can use to determine your home's basis and any gain that you can exclude. If you can exclude all your home's gain, you don't even have to report it on your tax return because the entire transaction is tax-free. Now, what happens if you do have to pay capital gains on a home sale? Let's say you're like Al and you can't exclude all the gain from your home sale. Well, in that case, you do have to report the taxable portion on Form 1040 Schedule D, Capital Gains and Losses, and on Form 8949 called Sales and Other Dispositions of Capital Assets. And as I mentioned, if you sell properties that are not your main home, like a rental or an investment property or a vacation home, and you do have a profit, you do have to pay capital gains tax on all of it. Al, good luck with your home sale, and thanks again for sending in your question. I hope this has helped anyone who's thinking about becoming a homeowner, or if you're already a homeowner, if you're thinking about selling one day, how to think through what the tax on that sale might look like. That's all for now. I'll talk to you next week on our Wednesday show. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast. It's audio engineered by Steve Rickyberg. Our director of podcast is Brandon Gatchus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. Our marketing and publicity associate is Davina Tomlin. And our marketing assistant is Cameron Lacey.